Hello, everyone, and welcome to the Real Life Real Estate Investing Show, where we try to guide you to getting your real estate wealth on. My name is Hector Hernandez. I'm a real estate fund manager as well as a wealth building and real estate coach right here on reallifetrading.com. Joining me today, as always, my buddy, my pal, my co-host, Mr. Luis Alejandro Lopez, as well as a very special guest. Luis, what do we got in store today, buddy?
How you doing, everyone? This is Luis Alejandro Lopez. I'm a real estate coach here at Real Life Trading, and we have a very interesting one for you today. All right, we talked to you before about how you buy them, how you fix it, how you flip it. We talked about an insurance agent, about how you protect your property in case of a hurricane like it happened to us. But how do you protect yourself? So now we have a great guest. Efrain Santiago is going to help us walk you through why you need your own insurance, life insurance, wealth insurance, so you create your wealth and then you protect it and then you pass it over to the next generation and the next one and the next one and the next one. It's super interesting. We're talking before the show and I'm mind blown. So Efrain, very nice to have you here.
Thank you. Thank you. Hi, everybody. My name is Efrain Santiago. If you can't tell, I'm Puerto Rican. I know, hard to believe. But yeah, I'm a financial strategist, and I'm excited to be here and give you guys a wealth of knowledge.
That's
I love
awesome.
it. Well, man, obviously, we brought you in here not just for the audience, but also in a very selfish way. We also want to learn how to protect our wealth, right? And like Louis said, we always talk about building that wealth and that generational wealth. And a lot of people, a lot of very savvy, super smart people often fall short of those steps that are needed to be taken to ensure that that wealth passes on to the next generation and it becomes true generational wealth. And that's something that I'm extremely passionate about. I'm always looking to learn. So when I met you, I think we met last year sometime at an event, you started telling me some of the stuff you knew. And I was just like, wow, tell me more. So every time I see you, I'm always asking you questions. I'm always picking your brain. And then it's like, you know what, let's just go ahead and share this information with the audience because why not? Before we get down to the nitty gritty though, let's share with the audience a little bit more about you. Obviously, you're the red-beard Puerto Rican. That's amazing, right? But what made you go down this path? Because I know from personal conversations between you and I, you're extremely passionate about this, and so I'm pretty sure that didn't happen overnight, and that's not something that you just do for money. You do it because you care. There's got to be a reason why. Can you let us in on that background?
Yeah, of course. So I'm originally from Jersey. And actually, I haven't always been in finance or being in insurance and all that stuff. I'm actually by trade an engineer. So I worked in the industry for about 6 years. I was a mechanical engineer doing manufacturing. So I worked for big companies. I was working for Lockheed Martin. I also worked for GE, General Electric. So I was very successful. The thing was, I didn't find something that was fulfilling to me. I'm great with my hands, and it was cool for the moment, but it wasn't really anything that was fulfilling for me. About 2021, I had a fraternity brother reached out to me, and he was asking if I needed help with my finances or anything insurance or anything like that. And I thought I was good. I was pretty successful in my career, right? So I was like, no, I think I'm good. But we had a good conversation. We were talking about my goals. I was getting into real estate. So I was like, yeah, I think I'm pretty good. Fast forward a year later, he had posted something, and I was like, "Ooh, that's interesting." He posted something about using life insurance with investing in real estate. So I was like, "Hey, can you tell me more about it?" So we set up a meeting. We finally met, and he showed me the whole concept. And I was like, "Wow, this is amazing." And he was like, "By the way, the company is expanding, so I think you'd be a great candidate. You could make some extra money on the sale." I was like, "Sure, I'll make some extra money. Why not?" So because we're all about the passive income, right? So I started doing it part time, and what I noticed was that as I was meeting with clients and educating them about finance, it's not just about selling insurance. We actually educate about finance. So when I was doing that whole education and realizing how little people know about the basics on finance, like compound interest, how money grows, taxes, things like that, um, I really grew a passion for it. And once it started replacing my income, I just went full on because it was more fulfilling for me. So that's the whole reason why I do it is because we need to educate more people because if you look at the statistics in America right now, it's crazy. There's tons of people living paycheck to paycheck, people barely able to retire, and it's just all over the place. And I want to be able to help people more and get into better financial situations. So that's the whole reason why I do it is to help others and give back as best I can.
That's awesome, man. I knew it had to be a good deep cause there. Thank you for sharing that. Really appreciate you getting raw with us and letting the audience know the true motivation behind it. It is truly concerning, like you said, the stats of where things are going. I read an article the other day, and then I started to click because I've actually seen it, right? That greeter at Walmart, that person at Home Depot on the way out, they're getting older and older. You know, that cashier, that bag person at Publix, these people are pushing 70 and 80 years old, and they should be out fishing or, you know, hanging out, doing with their family and their grandkids. And instead, they're having to work just to pay bills, just to cover expenses, not for fun, right? Like there's always been people who, yeah, we work because we love it, because we're, you know, we've all seen Warren Buffett. He's at the office every day at 98 years old or 99, wherever he's at now. But it's out of love. It's out of pleasure, right? It's not a necessity for him. And so there's a big difference. And so I really appreciate people like you, people like Lewis that are out here educating, right? And that's what real life trading and real life real estate is all about. We're all about providing the tools and the education and enriching lives. It's really the motto around here. We're not giving a man a fish. We're about teaching the man the fish and the woman so that they can go out and really implement these things in their lifetime that can really not only change their future and their retirement, but hopefully, again, that next generation.
Of course, of course. And also to mention, a lot of those people, they actually were retired at a certain moment in time, and they just ran out of money. They were banking on their 401k or the pension or some other things, which it didn't pay out the way that they thought it would. So now they ran out of money. Now what do you have to do? You have to go back to work and you have to get that Walmart job or Home Depot or stuff like that. And it's out of necessity. I'm sure they want to be out fishing and all these things, but like you said, they have to be out there so that they can pay their bills, and at least be able to keep the house that they have so they can pass that on.
Yep, exactly. So I'm very excited to get into the nitty gritty today. You've alluded to one of our topics that we're going to be discussing, and that's life insurance. Without further ado, can you kind of touch a little bit on life insurance, how we can all use life insurance while we're still alive, what the benefits are once we're gone for the next generations, and let's just go down that path first.
Yeah, of course. So let me provide a little bit of education and general overview on what life insurance is. So let me ask you. I guess the question is like I guess, what do you think life insurance is? When you hear life insurance, what do you think it is? Like, what would you say it is?
So I got the gist from you, so I'll let Lewis answer that one. So I don't want to
Yeah,
cheat.
so Lewis, go ahead, answer that one.
So for me, it's life insurance. I got a policy. Something happens to me, I end up down the hole. My wife, my family will will receive a nice amount of money, or depending on what I get. That's
Yeah, of
basically it.
course.
So you protect them. I protect them from me not being there. That's what I
Yeah,
think it is.
yeah. So a lot of people think that when their person or that person passes, now the family becomes rich and they're better off and they're more valuable dead than alive, right? So we actually call that death insurance. Because if it was called life insurance, wouldn't why are you only using it while you're dead? Like that's just death insurance. So life insurance should actually be used while you're still alive. So here's the two different types of life insurance. So you have term life insurance, and then you have permanent life insurance. So term is, I like to think of the word terminate. So with term life insurance, you have a set period. So it's usually around 10, 15, 20, 25, 30 years. And then you have a set coverage amount. So let's say, for example, you had $1 million coverage for 10 years. So you're going to pay a premium based off of how old you are and your health, and you're going to pay that same premium every single month for the course of 10 years. And then once that 10 years is up, that coverage is now going to lapse, and you could do one of two things. You could either get new life insurance, but now you're 10 years older, so it's now going to be more expensive, or you could let the coverage lapse, and then you're no longer covered. So that's term insurance. But then there's also permanent insurance. There's about 4 or 5 different types of permanent insurance. And with permanent insurance, it's going to be a little bit more expensive, but it's because it's for the duration of your life. So you're going to have it as long as you live, and you could have a lot more benefits, such as building cash value. So now you can borrow from it and stuff like that. So we'll get into that portion of things. But let me talk about what both of them have, and something called living benefits, and the reason why you can use them while you're still alive. If you were to get into, let's say, some type of accident, and you can't use 2 of your daily 6 functions for a period of 90 days or more, or in another example, you were to get diagnosed with like some type of cancer, heart attack, stroke, or anything else that qualifies, or in super extreme cases, the doctor says you only have 12 to 24 months to live. In any one of those cases, you can actually submit a claim to the insurance company, and they will accelerate a percentage of your death benefit while you're still alive, so that you can pay all your medical expenses, you can pay for your expenses, your living expenses while you're stuck in the hospital, right? You can use it to fund your children's education expenses. You could use it to investments, whatever you want to use it for, you can use it. But the point is, you have that money while you're living, when you need it the most. Because what do most people do? They get some type of illness, and now they have to stay in the hospital, get treatment. So they're going to take out loans, right? They're going to max out credit cards. They're going to go on GoFundMe, ask people for help. They're going to ask family for help. They're going to do all these avenues so that they are trying to pretty much extend their life and cure themselves. When they do, now they're stuck paying everything back. So now if they were in a financial struggle before, now they're even more in a financial struggle. So we want to make sure that less people are in that type of struggle, and more people can have access to these living benefits.
So let me ask a quick follow-up on that. When you said the term, we all pretty much understand it, but you called it a what was the other one? You didn't call it whole life, which is a term that a lot of people are using.
Yeah, it's called permanent. So whole life
is that the name of whole life?
Yeah, so whole life is a sector of permanent, but there's actually 4 different types of permanent policies. So you have whole life, you have universal life, you have index universal life, and then you also have variable universal life. So you have all those, and those are under the umbrella of permanent insurance. So a lot of people just consider whole life permanent insurance, which it is, but that's not the only permanent insurance. There's actually 3 other types besides whole life.
Got it. Okay. Can you give like a super easy high level overview on the differences between them?
Of course.
Like a third grader's listening, me.
Yeah. So whole life is going to be a little bit more on the expensive side. And like I said, all of these are for the duration of your life, but it's going to be a little bit more expensive than all the other ones, but you're going to be paying the same amount every single month. Or you could do it yearly or quarterly, however you decide. But you're going to be paying the same amount. And with whole life, you have they're going to give you returns. It could be anywhere from 3% to 6%. It depends on the company, but they're going to be giving you returns, which are called dividends, and that's pretty much a reflection on how the company is doing. They give you a portion of that, such as just like the dividends on the stock market, same type of thing. So that's your whole life. And then you have universal life. Universal life is going to be variable premiums based off of how much you want to put in, and that is the returns are going to act similar. You're going to get returns anywhere from, again, 4 to 6%, but you're going to have more of a flexible premium that you can put in. Variable universal life, that is going to be linked to the stock market. So you're taking all your money and you're actually putting it in stocks, and you're going to be it's going to be just like a variable. You go up and down with the stock market. And then you have index universal life. Index Universal Life is the one I personally love. I'm a little bit biased towards it, but I offer all of them, minus the variable because I don't have my securities license. But I'm a little bit biased towards that one. Why? Because they have this thing called indexing. So it's not a investment in the market like variable, it's just a reflection of the market. So what that means is you get all the gains up to a certain cap, the cap rate meaning that's the most amount of money you can make. And then when the market goes down, they have what's called a floor rate. So depends on the company, but you're never going to go below that floor rate. So typically it's about 0%. So let's say, for example, you have a cap rate of 15% and a floor rate of 0%. So when the market goes up, you get all those returns up to 15%. But when the market goes down, it drops to that floor rate of 0%, and you're not losing in the market. Then when the market goes up again, you get all the gains again. And then when it goes down, you're not getting any of the downfalls. So you're pretty much locking your money in every time you're getting gains. And it ends up becoming like a stairway to heaven because all you're doing is getting gains and you're getting no losses. So that is the reason why I lean towards the Index Universal Life over the other ones. But the other ones are very good options, and it depends on what the client wants, what their goals are, for us to really decide what the best course of permanent life insurance is best for them.
That's super interesting. I thank you for explaining the difference because I kind of knew some of it, but not all of it. The way that you explained it was nice and easy, and you could see the power of compound in some of those options, right? Because that's
Exactly.
essentially, one of the words that you led with is the power compound is going to kick in, and it's going to do its thing in a lot of those scenarios that you just mentioned. Let's dig in a little bit more into the life benefits, right? The difference between the term and I'm sorry, I keep forgetting because I keep wanting to go to whole life, but now you're telling me that it's not.
Yeah, it's permanent.
Permanent. Yes, permanent. Yes, permanent. Term.
Yes.
Okay, permanent. It's permanente. Okay.
Yes. Yes.
So let's dig into, do they both have the same living benefits? What are the main differences? And then, let's bring it back to real estate because I know you know where I'm going with it.
Yeah. So yeah, it depends on the company. Companies offer different things. So some companies may offer no living benefits for the term side, but they'll offer living benefits for the permanent side. So it's going to be depend on what type of company it is. So most companies offer the terminal illness, but they only offer like a small amount, and it's typically only like 6 months or 9 months, something like that. But it's going to depend on the company. But yeah, they're both going to offer permanent, and they also call it, another term for it is accelerated benefits. Accelerated death benefits is another term for it. So how do we lead all this back to real estate? And that's the biggest question that we have. So you have a lot of people that say, especially Dave Ramsey, buy term and invest the difference, which yes, you can do that. But here's the issue with that. Once you are done with your term, now you're no longer covered. Let's say you build a huge empire and you have huge amounts of houses, huge amounts of mutual funds, and you're a multimillionaire on paper, and you pass. So now you're going to pass all of that to your next of kin, your kids or your spouse or whoever. But guess what? What they have to do now? They have to go through probate. They have to pay all the taxes behind all of that. So they have to do, and then they have to say they don't want to be landlords. What happens then? Now they're going to have to sell the properties. Now they have to wait until all the properties sell and pay all the capital gains on every single property. So why are you making your family go through all that hardship just because you want to buy term and invest the difference when you could just have a whole life or a permanent policy, and you can have the policy pay for all the taxes that they have to pay on all of that, and they're still going to be uber wealthy with everything that you built. So so that's why you should have permanent, or a permanent and a term. The term is going to pay for any of the living benefits that you may have, and then the permanent is going to give you the large lump sum so that you can pass on to your family if you outlive the term as well. So how does this lead all back to real estate? Well, like I said, so what you do is, and the way we structure things is, we give you the least amount of death benefit, but it's going to give you a limit on the amount of money that you can put in. So let's say you wanted to start putting in like $1,000 a month, right? So you start putting in $1,000 a month, but we set it so that the most amount of money you can put in there a year is $12,000. So the IRS sets limits to how much you can put in, because if you put in over that limit, then it turns into what's called a modified endowment contract. So now they could come at you with taxes, and you have to pay taxes on all the gains and things of that nature. So we want to stay under the IRS umbrella. So you tell us what you want to put in. If you want to put in 1,000, we're going to set it to $12,000 a year that you can put in. So what that does is that's going to give you the least amount of death benefit. So it also has the least amount of costs. So a small portion is going to, let's say like out of the whole year, let's say maybe like $200. Just putting numbers out there. $200 is going to pay for the fees of having life insurance, and then the other $11,800 is going to now go into what's called an accumulation value, and that is the money that is now going to go into it is going to be compounded. Now, if it's in whole life, that's the money that's going to be giving you the interest. If it's in index universal life, that's the money that's going to be giving you the returns based off of what the market does. So you're also going to have a cash value bucket. So the cash value is the money that you have access to that you can pull out. So you're not withdrawing, you're taking loans, because we all know that any loan that you have is all tax free, because it's not any gains that you have, it's just a loan. So you're going to have a small portion that is going to be what's called a cash accumulation, or a cash value, and that is the money you have access to. So that is typically in the early years going to be much less than the amount that you put in. Why? Because they want you to gain more interest much quicker. So obviously, the more money you have in your cash accumulation, the more interest you're going to get. So they leave the availability much smaller. And typically around year 10, year 11, depending on how much you put in, you're able to have the same amount of accumulation versus the same amount of cash value. So they're going to be more of like a one-to-one, and you're able to borrow more from that. So as long as you have money in that cash value portion, you're able to borrow from that whenever you want. We only recommend you borrow about 90%, so that let's say you get into some hard times and you can't pay it, now your account can pay for itself. Because what you do is you're overfunding it. Remember, how much it costs is, let's say, $200 for the year, but how much you're putting in is $12,000 for the year, right? You're putting in much more so that you're gaining more interest from it, and you have more liquidity to access from. So now when you access from it and you go buy a property, now that money, let's say you had 100,000 in there and you borrow 50,000, you buy a property with that 50,000, that 100,000 is going to continue to grow as if you never touched it. Whereas if it was in the bank account, you took out from the bank and you bought the property, now you're 50,000 spent. You no longer have anything.
So basically, you become your own bank for the amount of money that you get in. Bingo.
Yes.
I love that.
And that is how an individual person can become their own bank. But then we also have the more advanced portion, that is how you have your family become a family bank, or in a family vault. So that one is going to be a little bit more complex. So when we talk about that, we get into the Rockefellers, right? So why is the Rockefeller family still one of the most wealthiest families in the world? So back in the day, you had the Rockefellers and you had the Vanderbilts. So the Vanderbilts were more wealthy than the Rockefellers. But what do you hear about the Vanderbilts now? Nothing. All you hear about is the college that they have, right? But they essentially don't have any more money. But the Rockefellers are still one of the most wealthiest families. What's the difference between them two? So with the Rockefellers, they had what's called they had a great estate planning. So they had a life insurance policy, and they had a trust as the beneficiary of the life insurance policy. So John D. Rockefeller had a life insurance policy on himself for whatever amount, let's say $1 million, right? So he passed, he put that $1 million into the trust. So now the trust has $1 million in it, right? So he set stipulations. Hey, none of my family can touch this unless they do a few things. They have to meet with some type of financial advisor so that they get educated on finances. They also have to donate to charity a certain amount. And they also have to have a life insurance with the trust of the beneficiary. Now, why these three things? The education, obviously, they have to run things by somebody. They need to have some type of education and foundation. Then you have the charity. Charity, it's always great to give, it's always great to have, but it's even better to give back. Plus, it also becomes an extra tax benefit for the trust itself. And then why the life insurance? So let's say one of the kids takes out 200,000 to put it to start their own business and it just flops. Now they lost 200,000, right? So when they do pass at a certain moment in time and they had that life insurance policy on them, now that life insurance policy goes back into the trust, it rejuvenates the amount that they lost, plus it adds even more. So if you continuously do that every single generation, every single year, your trust has more and more and more and more money on it. Why? Because people are going to pass. It's the inevitable thing that's going to happen, right? No way, no way, shape, or form you're going to bypass that. But might as well make your last name known and have your future generations uber wealthy by having more and more money into the trust that you set up, and really limiting how it's going to happen because you set the stipulations inside the trust.
That's very interesting. So let's say my kid right now, he is 10 years old. I buy him life insurance.
Mm-hmm.
Okay, so let's say he decides to do whatever with that money and he ends up losing money at the end of his life. He will replenish the fund for his kids and his kids' kids. Anyway, doesn't matter what type of life he lives, he's still leaving a legacy for everybody.
Exactly.
That's
And we show
amazing.
them, and we have my company has access to, and we partner with different law firms so that they can legally structure it properly. Um, so because it's all about all about the words that are on the piece of paper. It's just a piece of paper unless you have the right words on there. So so yeah, the other thing that trusts do is a lot of people don't know this. When a person passes, right, all their assets, if they don't have a will or a trust, it goes to something called probate. And now the court is going to decide where everything is going to go. If they let's say you wanted to leave your house to your parents, right, but now your spouse comes and say, hey, I want the house should be left to me. They can automatically go to your spouse, or like an ex that you had or something like that, right? So things can be distributed the way you don't want it to. Now if you have a will, now the court, they still have to go to probate, but the will is going to pretty much decide everything. But if somebody else says, hey, I think I deserve that, they can actually go out and dispute it, and they can potentially win that case. But then you have the trust. Trust is now going to bypass probate, and everything that it says in the trust is actually going to come to fruition. So you're pretty much dictating everything that happens in your life, and then after you pass, you're dictating everything that happens with this document itself.
Trusts are great for those micromanagers like this guy. I still want to have a say in what happens even when I'm gone, but it's for the good, right? Or so we tell ourselves. But and it's great that you brought that up. We segue perfectly from life insurance to estate planning because they go hand in hand together. And I've seen firsthand after the passing of my grandma what a probate process is, right? And it's literally a long, drawn-out process. She had not a ton of assets, but you still got to post it all everywhere on the newspaper. Do we owe this? Was there any debtors out there? Anybody who's going to put their hand out, right? That's basically what probate is. It's like who's got their hand out, right? Before your family gets to touch any of your assets. Everyone out there in the world has first dibs, not just the government.
So wait, that brings me down. Let's take it back. So it's two components. The insurance fits the trust, correct? Let's take it from a super basic level. I'm 5. What is a trust?
So a trust is pretty much a legal document. And to be honest, I'm not an estate planning attorney, so this is my personal knowledge of what it is. So I just want to put that disclaimer out there. And all of the everything I've been saying is my understanding behind it. It can go more in detail. I can be wrong about certain things, but that is my general understanding behind it. I just had to put that disclaimer out there so people don't say, "Hey, you're wrong." That's how I was just saying. So a trust is pretty much a document to pretty much define. So let's say in real estate, right? So you own, typically people put properties under their own name. So instead, you can take the property and put it under a trust, and now you own no, pretty much essentially nothing. You don't own anything, your trust owns everything. So your trust is going to give you anonymity, if I said the word right, and make you anonymous so that, let's say a creditor comes after you or somebody comes to try to sue you um, for one of your investment properties. The lawyer's going to come after you and say and look at pretty much everything that all the assets that you have. And if they don't see anything, the lawyer's going to say, "Hey, this person doesn't have anything. You're going to spend more trying to go after this person than you're going to be able to get out of it." And why? Because everything is structured properly and layered between trusts and LLCs and all this layering to provide all that anonymity so that essentially you're not owning anything. And when you do pass, everything that's said in the trust, you're going to have what's called a trustee that's going to distribute everything based off of what the trust says.
Yeah, so the trust has those two components. It's not just making sure that your wishes are followed right in the way that you structure things, but it also has that ability to kind of conceal your assets, so to speak, to keep people at bay. I'm not going to try to pronounce that word because it's, but I do want to put this out there is that if there's any estate attorneys out there on YouTube watching us, whether Efrain is right or wrong, please comment, hit like, subscribe, and just give us some feedback. And we'd love to have you on and really get in depth here. But I do want to kind of throw it right back to real estate and to the life insurance policy, because this is something that I found to be very powerful. And I'm going to ask you the question the way that it was explained to me years ago. Say Louis loves to flip houses and flip real estate because he loves at the end of the project, he walks over with a big sexy bag of cash, right? That's what he calls it. That's his thing. It's his motivation. Besides impacting the community and all of that, it's always nice to walk away with a sexy bag of cash. Say that bag of cash is 50 or 100 grand. Say, "Hey, Efrain, would you then recommend I plow that $100,000 into a life insurance policy as a lump sum, or would you have me pay that $1,000 a month? What is the benefit? What's the right answer?" And I get that it's not universal, but let's just try to give a general idea.
Yeah, so it's going to 100% depend on what his goals are. So if his goals are going to be to use that money again so that he can go ahead and fund another property and things like that, then we can structure it so that you're putting that whole 100,000 in there. Let's say you're doing that once a year and you're making $100,000 every year off of every property. So we set the max limit to 100,000, and every single return you're putting in 100,000, and then you're taking loans out to fund more properties and things like that. So we can do it that way. Another thing that we can do is we can do what's called annuities. And if you want lifetime income, the guaranteed lifetime income, we could take that and we can put it into an annuity so that it can grow and then give you that lifetime income that you want whenever you're ready to retire and take that money out. So it all depends on what type of thing you want to do. So there are those two different types of options. And then you can take out every year from an annuity, but you're going to have to pay taxes on that. So that's the downside of that. That's why we prefer the life insurance over the annuities, because you're taking out loans, and with the loans, you're using the insurance company's money, because we all like OPM, other people's money. So yeah, that's the benefit of choosing a life insurance over an annuity. But yeah, it depends on your goals, on if you want to do it a small amount monthly or a larger amount for the whole year. you can fund it the way you want to see or the way you see best. And then the other thing you can do as well, I didn't mention this. Um, you can also use that to, let's say, if you want to become a hard money lender, you can become a hard money lender with that. You can take that money, borrow that money, you give it to somebody else. Now you're gaining interest from your money on the life insurance side, plus you're gaining interest from the hard money lending, and now you have extra money to pull and fund your policy with that as well. So there's a bunch of different avenues that you could do. If you want to be a hard money lender for real estate, you could do it for cars, you could do it for this, that, whatever you want to do it for.
Or you can become an investor with people like me that do flip house. So you want to get into flipping houses, but you don't know how to start. Instead of getting your hands dirty, boom, you find a partner, you find somebody that's actually doing it, and you invest the money with them per project or per JV or whatever you want to do it, and you will be in the real estate, real estate world. Just don't deal with paints and toilets.
Yeah, and let me ask this to make sure that I understand it correctly, but also that the audience understands it. So let's stick to the $100,000. Lou absolutely wants to keep buying money, so he can plow $100,000 into that life insurance policy, borrow 90 grand, go buy more real estate, and is my understanding that the $100,000 is still earning interest?
Yeah, so it's going to again depend on, to get a little bit technical, it's going to depend on how old the policy is. Because remember, I said in the early years you're going to have access to less. So if he's putting in 100,000 in the early years, maybe he'll start off having 50,000 available,
Gotcha.
so that he can take out, and he's only going to want to take out maybe 45 or 40,000 from that. So the fees will be called our front loading because you're going to have more fees in the front end, but because you're earning more interest, that is now less of a risk factor to the insurance company because you have more and more, and you're pretty much funding your own policy. So yeah, that money, any money that you borrow, is going to continue to increase as if you never took it out. Why? Because your accumulation value is still going to stay the same. So when you take out loans, there's a few different options. So you have one option that's called a wash loan. So a wash loan is typically, let's say the company charges 3% for that loan. They're going to credit you 3%, and it's going to become a wash. So you're not really paying anything for that loan. And then you have what's called a participating loan. The participating loan is going to be a bigger interest rate, but still typically right now different companies are at about 5%, which is still less than right now what the banks are offering. Um, so with that participating loan, you're paying, let's say, that 5% for that loan, but your money is still participating in market indexes. So let's say you get 10% gain. Well, you just got a 5% loan, so the 10% paid for that 5%, and you just gained 5% on the money that you're using on other assets and other things like that. So, and then the rest of that other money is gaining that 10% as well. So you're pretty much not even paying anything. But again, when the market
So
goes down,
my money's got two jobs, a day job and a night job.
exactly,
I love it when my money's working hard.
And in top of that,
exactly,
when you are paying, you're paying yourself. So whatever amount that you're paying additional, whatever, so you pay yourself. Man, that's a really, really good one. Now, I do have another question. Let's say Hector. Hector has two kids. Hector wants to set them up for life. Can he get life insurance for them, for each one of the children?
So
How does it
unfortunately,
work?
unfortunately, the child has to be 15 days old. And that was a joke because 15 days old is the soonest a child can get life insurance. So
Okay.
yeah, at any age a child can get life insurance. It can be usually people do term. I mean, sorry, not term, permanent. So people usually do permanent, and with those, there's some companies that give living benefits to children as well. So if something happens to the child, that they get some type of serious illness or something like that, if you got it when they were 15 days old and there was no sign of anything like that, then you can take out from the policy and pay for, let's say they have leukemia or something. You can pay for all that with using the insurance company's money. Like, why are you not doing this? It doesn't make any sense. But you're putting all this money, let's say you start with $150 a month. It's a small amount, but over the course of, let's say, 18 years, it becomes a lot of money. Plus, you're gaining all the interest on top of that. So, um, so once you're gaining all the interest on top of that, it ends up you can use that money now for college if you want to, or let's say they want to buy a property sooner, you could use that to buy property or their first car or wedding or anything like
So
that.
it's
So it
nice.
becomes better than a 529 plan because 529 is only for education. And then if they don't go to school, now you can put it into a Roth IRA, but they still don't have access to a 59.5. So it's cool, but we want liquidity. We like to use our money when we want to use it, not when the government says we can use it.
Yeah, and even if then you're asking for a loan, let's say a college loan, student loan, but instead of paying the bank or paying somebody else, you're paying yourself. So even
Hmm.
if you have to pay over 10 years or whatever amount it is, once you get a job, whatever, you're paying yourself. That's amazing. You're the bank. I love that.
Yeah. And then the other
I
thing
love
is
that.
with other accounts, let's say like a 529 plan, with the 529 plan, you when your child goes to apply for FAFSA, they're going to see the 529 plan or the custodial account and these things. So it's because it's with government funded things. When you go into a life insurance policy, they can't see that money because it's in life insurance. It's all cash value. They can't see that. So when they go to start applying for grants and loans, they're going to get more grants and loans. And let's say all 4 years they take out a bunch of loans. Let's say they take out government loans. Now all you have to do is take the policy, borrow from the policy, pay all your student loans back, and now the student has great credit right coming out of college because they used government loans. They paid it with the insurance company's money, and they started off right out of college with great credit because they were able to do all of those things and pay off their student loans right then and there.
And again, it's not the life insurance money. It's your money in the life policy. That's great. That's really great.
That
Yeah.
is amazing, man. It's so much more to unpack with the estate planning still, but I think we're gonna wrap it up here because we're a little over time, and I think this has been a lot. It's been a lot for me. It's definitely been a lot of great information with the life insurance, and still so much to learn within this world. So we look forward to having you back, Efrain. How can people get a hold of you? If
Of
somebody
course.
heard your greatness right now, besides that attorney that's going to correct you in the comments, how can
Yeah.
someone get a hold of you?
Yeah, and we just scratched the surface
Oh, yes.
on what everything that life insurance can do because this is just some of the things. But I'm going to share my screen right now so that you guys can see my contact information. And this is my contact. I have my virtual card here, as well as my name and my phone number and email there. And that's the name of the company I'm with, Global Financial Impact. We are a broker, so we don't have any of our own products. We partner with over 25 different companies, and these are all companies that you have heard of. So we partner with all these different companies, and we see what company is best for you, for your goals, and we go ahead and say, hey, this is the company I recommend. This is the product I recommend, and these are going to be the costs. And then we go from there. If you don't like this company, we'll go to that company. If one company denies you, we'll go to another company. So that's the benefit there as well.
That's amazing. Yeah, that's the benefit of working with brokers across the board, right? Whether you're working with a loan broker, whatever kind of broker, it's that access that you guys provide to multiple players in the industry and that knowledge. Because you're gonna have more knowledge about one particular insurance company than I am. I might just have heard what I read online. Exactly how they pay out, stories from past clients and things like that. So that's amazing. If you're out there in YouTube land and you are watching this, don't forget to hit like and subscribe if you like the content. Give us some feedback in the comments, but go ahead and grab Efrain's contact information, reach out to him. Like we said, we just barely touched the surface on
And
the impact.
I'm gonna leave the contact information in the comments below so you can click directly instead of having to, QR codes and the whole thing. So you can reach Efrain directly from there. Okay.
Perfect.
So
Thank you so much, Efrain,
that was
once
awesome.
again for your time, your knowledge. This has been extremely valuable from a super selfish standpoint, but also for the community at large. I'm sure that everyone has enjoyed what they learned. Thank you. Thank you. I cannot thank you enough for your knowledge, man.
Of course, I've had a great time. Thank you guys for having me, and I'm looking forward to coming again to explain more knowledge, more in depth, more advanced, and just have fun all over again.
Awesome. Thank you, man.
Love it.
All right, and with this, we'll wrap it. We are, as always, at reallifetraining.com. You want trading information, trading classes, how to trade the stock market, look us there. If you want more real estate, we're at reallifetraining.com/RE. I'm going to leave everything on the bottom so you can go to the links and, reach out, subscribe. Our email, realestate@reallifetraining.com. Again, you can harass us if we said anything that was wrong. And again, we are starting with a new channel. So please like and subscribe so the algorithm can take this and we can make great more videos for you. Thank you, Frank. Much, much, much appreciated. You have like the light bulbs going in, bing, 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 bing. I love that. So thank you so much. And we'll see you guys in weeks. All right.
Love y'all. Have a good one.
Thank you.